Welcome to Capital Link's company presentation series.
Good day to everyone. I am Nicholas Bornos of Capital Link, and I would like to welcome you to the 2025 Capital Link company presentation series. In this series, company management highlights the company's current operations, business development, strategy, growth prospects, and sector outlook. We are privileged to have with us today the senior management of SBLK Carriers. Namely, we have Mr. Hamish Norton, President, Mr. Christos Begleris and Simos Spyrou, CFOs, Mr. Constantinos Nanopoulos, Deputy CFO, Ms. Charis Plakantonaki, Chief Strategy Officer, Mr. Nicos Rescos, Chief Operating Officer, and Mr. Constantinos Simantiras, Deputy Chief Information Officer and Head of Market Research. So SBLK, you all know SBLK. It's the largest operator, owner of dry bulk vessels in the world. The company operates 156 vessels in the dry bulk sector. The company shares are listed on Nasdaq under the ticker symbol SBLK. So in terms of logistics, very quickly, we will begin with a company presentation followed by Q&A. Please note that participants can submit their questions through the Q&A button at the bottom of your screen during the webinar, and your questions will be replied during the Q&A session. And now, before we begin the webinar, kindly note that our discussion is strictly for informational and educational purposes and should not be relied upon. The webinar does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for it. And as a further disclosure, we have the privilege to work with SBLK on investor relations. And now let us begin with our discussion and presentation. I will turn the floor over to Mr. Hamish Norton, the President of SBLK Carriers.
Thank you very much, Nicholas. Happy to be on this webinar. Good morning, everyone. Paul, if we could have the next slide with our forward-looking statements disclaimer, and you should take a look at this and read the forward-looking statements. Next slide, please. So why invest in SBLK? We are the largest, the most liquid dry bulk company in the public markets, with very significant operating leverage in the dry bulk market. We have the largest market capitalization and the greatest liquidity among listed peers, I think not just in the US, but around the world. 156 vessels with an average age of just under 12 years. 80 of these vessels are so-called eco vessels, very fuel efficient. 98% of the fleet is fitted with exhaust gas cleaning systems, otherwise known as scrubbers, that allow us to use less expensive high sulfur fuel. We are a consolidator in the dry bulk industry. We've more than doubled our fleet through 9 mergers since 2018. We are basically fully integrated. We do our own management of the vessels. As partly as a result of that, we have the lowest operating expense and G&A of any of the peers, while maintaining the highest RightShip ranking. RightShip being a vetting organization owned by some of the largest dry bulk charterers. We have a very strong balance sheet. Our net debt per vessel at the moment is below the scrap value per vessel, and we've reduced that leverage by 50% since 2020. We've paid a lot of attention to being shareholder friendly in our capital allocation policy. Until relatively recently, we had a policy of basically paying out 100% of operating cash flow, assuming that the cash on our balance sheet met a threshold of cash per ship, which was required by our board. In the meantime, most of our shareholders have been asking us please not to pay that full dividend, but given that our share has been trading for a while below the net liquidation value of our hard assets to use some of the cash that we had been paying out as a dividend, either for future opportunities or to buy back shares at a substantial discount. But since 2021, we've paid over $1.33 billion in dividends and made over 440 million of share buybacks, all well below net liquidation value of hard assets. You know, the shareholder-friendly policies are not an accident. We have the strongest corporate governance of any of the dry bulk peers. We have a majority independent board, which has financial investors on the board and ship owners on the board coming from companies that we've merged in, and they're happy to sit on our board. Our compensation committee takes its job very seriously. Management incentives are aligned with the shareholders' incentives. And we are a pioneer in efforts to decarbonize, and we've been very transparent with investors. We've issued an ESG report since 2019. I believe we were the first dry bulk company to do that. Next slide, Paul. Thanks. So this is a history of our M&A activity and our ability to grow the fleet through acquisitions using our share at or above NAV. And we're very conscious of not issuing shares unless it's good for the shareholders as a whole. Next slide. And this is, again, looking at creating value for shareholders. You can see on the upper left, the dividends, share buybacks, and regular debt amortization. We are continuing to amortize debt at the rate of about 250 million per year. Possibly a bit less, but we're getting our leverage down quite quickly, which we think is the right thing to do in a market where we're going to have a substantial balance sheet to pay for decarbonization. And so you can see that our net debt at the bottom of the page has been reducing quite rapidly. Next slide. So I mentioned that we have among the lowest OPEX costs and the highest RightShip scores, and you can see star is the red bar in both the average daily OPEX chart and the average RightShip safety score. Next slide. So as you may know, in April of last year, we closed a merger with Eagle Bulk Shipping, which was a share-for-share merger, which we did using our shares at net asset value. And we are realizing substantial synergies from that merger. At the time of the merger, we told people that by the end of 2025 that we would have synergies at the rate of 50 million per year, and we're well on the way to doing that. Our Q3 2024 synergy run rate was 6.5 million per quarter, which is at about half of the level that we will achieve by the end of 2025. And that's coming from interest savings, insurance savings, technical management savings, overhead savings. And it's also coming from increased revenues on our own fleet of Supramax and Ultramax ships that are being chartered in a more complex way that Eagle was particularly talented at doing. Next slide. So this is a chart that shows the distribution of our vessels in terms of vessel class. we have 156 vessels, not including vessels chartered in. We have 5 new buildings, Kamsarmax, that were very ordered at very low cost with very high technology, very low fuel consumption. These were a very good deal that are worth substantially more than we paid at this point. Next slide. So this is a very wordy slide, but it just goes to show that our ESG strategy is very deep and multifaceted, but we are very focused on the future of decarbonization, and we're I think preparing ourselves for a very complex future, which is frankly the best thing that could happen to us. We think the more regulation, the more complexity in shipping, the better we do. Being the largest of the publicly listed dry bulk companies, we think we have a big advantage over our smaller peers in a more complex and more regulated world. Next slide. And probably the next slide after that. So market overview, I'm not going to go through this in detail, but we're clearly headed for a difficult period in the market. The order book is quite small, luckily. The demand for dry bulk movements has not declined, and in fact is growing. But it's clear that there's an excess of capacity for the moment, and that will take a little while to clear. And we think this probably is not going to be such a bad thing. Our balance sheet, as I said, is very, very strong. We won't have any issues dealing with reduced cash flows for a period. And, our share, frankly, is priced at a very low level compared to the net liquidation value of our hard assets. Basically, the price at which private shipping interests are willing to pay for these assets, and asset prices have gone down as a result of the relatively low charter rates in the market. But our share is trading substantially below the net value of the assets. So while we'll have a difficult period in the market, we think that the share, frankly, right now is a steal. Next slide. This is again a market slide, just looking at the demand, and demand for dry bulk movements does look like it's growing, just not quite fast enough to pull rates up, for the next quarter or two. Next slide. And the order book, as I said, is pretty low. As you can see, it's not at record lows, but it's a lot closer to record lows than it is to record highs, or even to middle cycle order book levels. Next slide. And decarbonization is going to have a very favorable effect on the market for eco ships, because basically the only way for a fuel inefficient ship to decrease fuel consumption and emissions without incurring major capital expenditures is by slowing down. If you slow down a little bit, you save a lot of fuel. And at the same time, if the fleet slows down, the carrying capacity shrinks, and that creates a shortage of carrying capacity. So it's basically going to push charter rates up for the more fuel efficient ships. And I think we're very close to the last slide. I think that is it, and we'll take questions now, and I see we have some questions. Says, do you manage bunkering in-house? Are you using any biofuels to lower carbon emissions? Why or why not? And I think Charis Plakantonaki, our Chief Strategy Officer, should take that question.
Thank you, Hamish. So yes, indeed, we have a dedicated bunkering team in our offices, and we do manage our bunkers in-house. As of 1st January 25, we have seen the fuel EU regulation coming into force, which basically requires our vessels which trade in and out of Europe to reduce the carbon intensity of the fuel that they burn. And we will be complying by burning biofuels, given that primarily we burn HFO in our vessels. So we will be blending HFO with biofuels in order to comply with fuel EU by reducing the carbon intensity of the fuel we burn. Also, this helps us offset costs that are related to the EU ETS regulation, which is already into force. And also looking at the global level and at the longer term, we do see the IMO currently discussing market-based measures, including a fuel standard at the global level. So once this is implemented, which is expected to take place sometime in 2027, we'll have more clarity around that in a few months at the next MEPC. We expect that biofuels will be one of the options to comply with global market-based measures, along, of course, with other green fuels which may be available at that point in time. Thank you.
Thank you, Charis. So I have another question. What are you doing to increase the order book? And I should probably make clear what we mean by the order book. It's basically the book of orders for new building ships at shipyards, and this is basically tracked by various dry bulk shipbrokers who basically make inquiries at the yards of what orders they've got. And so basically you want the smallest order book of new buildings that you can get, if only that were in our control. You know, we can increase the order book by placing orders, but we can't shrink it. You know, I wish we could. So what are we doing to increase the order book? We've got 5 new building Kamsarmaxes on order, but generally we think new buildings are probably too expensive at this point. And you know, we think new building prices will decline and that there will be an opportunity to order at better prices in the future. And then what is your outlook for more consolidation in the dry bulk field? Will you be looking to do additional deals, as buying a company like NMM or GNK would be cheaper than buying new ships, as NAVs are, as basically market prices are below the net asset value of the companies? And, you know, that's certainly correct. You know, we would love to buy companies using our share at or above NAV. It's not that easy to do these deals. These deals always are very hard to close. And it doesn't necessarily get that much easier with the share price higher, because then people's expectations go up. But you know, it's very hard with the share trading at a big discount to NAV also. We look at opportunities frequently, and we're always doing our best to try to close them. And we've managed to close quite a few, but I can't anticipate specifically, you know, when we would do the next one. What will the opening of the new Simandou mine in West Africa do for the iron ore market? I think this is for Mr. Constantinos Simantiras.
Yes. Well, this is definitely a project that we look forward to. It's a major iron ore mine of very high quality, located in the Atlantic with Chinese interests. So we expect it to have a positive effect on iron ore trade, ton miles of iron ore trade. We also expect it to gradually put downward pressures on iron ore prices and perhaps incentivize substitution of inefficient and low quality iron ore imports to China, or even the domestic iron ore production in China, and with iron ore from the Atlantic, from Simantu, from Vale, which should have a net positive effect and will require significantly more Capesize vessels in the process.
Okay, and I get a question that says, just keep what you were doing and buy back stock. But why do you think there is no interest in dry bulk now? And you know, I wish I knew, but you know, I assume that there's less interest in a low market than in a high market. So I would tell you that this is probably an opportunity. Any thoughts or comments on the effect of tariffs on trade flows and ton miles? Constantine?
Well, the tariffs, you know, the easy answer is that we expect it to have such a negative effect. Generally, tariffs are associated with a hit on trade. Having said that, we do expect to see perhaps an increase in short-term volumes stocking ahead of potential tariffs. It appears that the tariffs are not going to be implemented as quickly as thought. And also, we also expect, we've seen in the past that tariffs create trade inefficiencies and sometimes also with a net positive effect for the market. Another point that we might see is that there's a possibility of stronger grain volumes coming out from the Latin America during the Latin America season. So some changes in the seasonality, especially for the Panamaxes and the smaller sizes.
Okay, and then I get a question about approximately what are the current time charter rates? Maybe Constantine, you could talk about the spot and forward markets.
Well, the spot markets are currently on Capes are at about on an unscrubbed non-eco vessel, the Baltic vessel, it are around 10,000 per day. On the Panamaxes, the Kamsarmax index stands at $7,800 per day, and the Ultramax index stands at approximately $8,800 per day. These are very low levels. We are currently in the heart of the seasonal low. And this year we have a return to traditional seasonality, something that we didn't experience last year. This is in a way also reflected in the forward curves, where we do see a strong increase on all three sectors as of the second quarter, and healthier numbers into Q3 and Q4. As a comparison, Capes for the full year stand at around 17,000. Again, the non-eco Cape without scrubbers. Kamsarmaxes stand at around 11.5, and Ultramaxes again at around 11,000 per day.
And you want to talk about the premiums that we get to the FFA market?
So important to note that, yeah, depending on how efficient the vessel is, you would be assigned a premium on those values. For example, a Newcastlemax vessel would get a premium of about 35% on top of the Baltic indices. Eco Kamsarmaxes or Ultramaxes would get something between 10 and 15% on top of the indices. And Starbulk is equipped with scrubbers, which would add the current forward curve stand at about $100 per ton spread, the high five spread, the difference between the two fuels. And this would translate to an additional 1,500 to 2,000 per day across the whole fleet.
And then I get a question of any idea when Chinese domestic demand for steel may return. And their steel demand is not that far down, in fact.
Well, focusing on domestic demand, for sure, China during the last 3 years has suffered due to the real estate crisis. They're entering their fourth year of downturn. They have been stimulating in a more aggressive manner over the last quarters, and we are seeing the last couple of months some signs of stabilization, at least on the real estate sales and prices. Now, we do expect that the stimulus will have some positive effect on domestic demand. However, over the last last 2 years, we've seen that a lot of support has come from exports, so we might see some downward pressures there. And it's worth mentioning that although crude steel production was declining throughout 2024, during the last few months of the year, that we've returned to year-over-year growth. And at the same time, it's interesting to note that the really bad profitability that prevailed between the second half of 2023 and first half of 2024 appears to be improving a bit, mainly due to the strong correction in iron ore prices and coking coal and coke prices. So it's very difficult to pinpoint when domestic demand will return, but we do see some early signs, and we are optimistic that over the next 2 years we will see some type of domestic consumption region coming back.
And I've got a question I think is from Nicos Rescos. Question is there a way to reduce the mileage of empty vessels returning for loading? Basically, is there a way to reduce ballast legs?
Thanks, Hamish. I think this has to do with vessel category. And as Constantinos will also say, that you can probably do that on the smaller ships like the Ultramax and the Supramax fleet we have. So through the Eagle merger, we are able also to take advantage of backhauls with steel cargoes coming back from the Far East position into the Atlantic. It's a bit tougher to do that on the larger ships that carry iron ore or coal. But what we're trying to do, whether it's Simandou or other hubs of iron ore exports and coal exports, is minimize ballast legs. This is what is happening also in the market, at least for certain categories of the ships, like Kamsarmax and Capes.
And then I have another question for Constantinos Simantiras. What is the likely worst case scenario in your view of day rates for Newcastlemaxes and Capes? Would 28,000 and 20,000 a day be prudent, respectively?
This is a question that's very difficult to answer. I must say that looking at historical data, we've seen Cape markets go below 10,000 per day. We've seen Newcastlemax premiums shrinking. However, that would require a depressed market for a prolonged period of time, and would mainly require a strong correction of oil prices and bunker costs. If you look at historical data, you will see that periods where the market was sustainable at such low levels was periods where bunker costs dropped below $300 per ton, like in 2020, in 2015-16. Now we are in an environment of stricter environmental regulations, higher bunker and higher costs of speed. So it's less likely that we will see this type of markets. So a worst case scenario would be somewhere around the 10,000 on the standard Capes, non-eco Capes, but difficult to assign probability.
So I have another question for Nicos Rescos. Do you do any hedging of your fuel costs?
That's mainly on the high 5 spread. We are taking cautious moves in the quarters, but nothing that would constitute a major positioning because the market is volatile. We're seeing major geopolitical events influencing oil prices. So we have a view on high 5 spread, and when we see that we are within a margin that will make sense for us to hedge, we will do, but not in a huge volume in any way.
Yeah. And I have a question for probably Simos Spyrou. Approximate debt amortization per annum in 2025 and 2026.
So you should estimate a figure of 56 million per quarter as we stand. So it's about 225 million annually. But as we are working on some refinancings that we will announce hopefully when we report results next month, this should come probably a bit lower. But the figure of 225 right now is safe to assume.
Yeah. And then there's a question that says, what is the right share price based on your net book value? And, you know, I think net book value is probably the wrong figure to use. I think what people look at is the market adjusted net book value, or, you know, what some people call net asset value. And that should be really, for Star, below the minimum that our share price should reflect. You know, we have lower costs than almost anybody else in the dry bulk business. We have higher revenue than almost anybody else in the dry bulk business. We make more money with a given ship than anybody else pretty much will make. And so it is basically ridiculous that our share is trading below the liquidation value, net liquidation value of our hard assets. That's basically giving substantial negative credit to management, even though we're producing more profit from the same assets as compared with anybody else. This is why I think that there is a tremendous opportunity right now. You know, despite the fact that there will be a difficult market for a little bit, that difficult market is reflected in the private market value for the ships. You know, it doesn't make sense to double the discount in the public market. And then there's a question, how big is the problem of the dark fleet? And I think this is not a dry bulk issue, but Nicos Rescos, do you have any comment on how big the problem of the dark fleet is? Does that apply to dry bulk at all?
I think it applies much less on dry bulk versus the tanker fleet. It's very difficult to make any kind of assessment on that. Yeah.
And then I get a question, 60% dividend is linked to operating cash flow, i.e. Net profit after tax plus depreciation. So basically our new dividend / capital allocation policy is basically explaining to our shareholders that 60% of basically cash flow from operations after debt amortization is about the maximum dividend we're likely to pay. We're going to keep paying a dividend because we know there are a lot of investors who are required to not invest in stocks unless they pay a dividend. But we're going to prioritize stock buybacks when that's the right thing to do, debt pay downs when that's the right thing to do, and retaining cash for future strategic investments when that's the right thing to do. You know, we're always looking for the right thing for the shareholders. We are all shareholders. You know, our CEO and our board are shareholders. So, you know, that's what drives us. Question for Charis Plakantonaki. I think you talk about decarbonization and mentioned biofuels. What other technologies are you pursuing to reduce the carbon footprint of the fleet?
Thank you, Hamish. So we have a very rigorous decarbonization strategy that we're following For starters, we're paying very close attention to our bunker consumptions and respective carbon emissions. The way we do that is that we're leveraging telemetry on board our vessels, but we also have an in-house dedicated vessel performance monitoring team, which means that whenever we see overconsumptions, we take immediate action, whether at the technical or at an operational level. At the same time, we are implementing both operational and technical measures to improve the energy efficiency of our fleet. On the operational front, for example, we're prioritizing hull maintenance. So we make sure that the hulls of our vessels are as clean as possible in order to minimize the friction and improve energy efficiency. A number of ways to do that. We are performing frequent hull cleanings. We are accelerating dry docks whenever needed. We are using anti-fouling paints, and we're also piloting remotely automated hull cleaning robots. On the technical measures front, we are implementing a number of technical solutions, including, for example, ducts, boss cap fins, shaft power limitation, among others. And on the operational front, in terms of systems, we are deploying new technologies, leveraging also artificial intelligence in order to perform voyage optimization, whether this means optimizing our speeds, optimizing our routes, or determining optimal arrival at port. And this basically enables us to minimize bunker consumption and thereby also keep emissions lower. Now, along with existing technologies, which I already mentioned, we're of course also investigating new technologies like carbon capture and storage on board our vessels, which is a developing technology. We're piloting that on our vessels. And we are also staying abreast of developments with regards to hydrogen-derived fuels, including green methanol and green ammonia. Of course, a number of challenges on that front still need to be overcome in order for our industry to safely and efficiently use these fuels. But we are examining these solutions as well, looking into the longer run, and participating in a number of feasibility studies, including green corridors, and of course, partnerships with other stakeholders in the industry. Last year, we formed the Maritime Emission Reduction Center along with other reputable companies which have offices in Athens. This is a global center which will aim to improve the energy efficiency of the existing fleet. So we are also trying to leverage collaboration with other stakeholders in the industry in order to further advance, develop solutions that reduce emissions for our vessels. Thank you.
And I have a question for Christos Begleris. 50 million of cost cuts. What was the run rate at Q3 24?
Well, we had an initial costing of cuts that was due essentially to refinancing the vessels as well as renewing the insurance for the vessels. And that was at 5 million. That was one off. And then essentially the run rate increases as we are able to achieve more and more synergies. So synergies started in the region of $700 to $800 per day for the Eagle fleet. So that's essentially $800 times 50 vessels times 90. That's approximately 3.6 to 4 million per quarter. But essentially, as we are able to bring and spread the synergies on the cost side more towards the Eagle vessels, these numbers are going to be increasing.
Okay.
And I add something here?
Yes, sure.
The run rate on Q3 was 26.3 million. So the Q3 cost cutting only in Q3 was 5.9 million on the cost side and 670,000 on the interest expenses. It's a bit misleading because on the third quarter we did not have dry docks, which will further increase the synergies. But if you just take into account the third quarter, it was at 26.3 million, the run rate.
And there are some revenue synergies as well.
This is on the cost, the question. And basically, basis where we are, we feel that we are going to be able to meet the 50 million goal before the target that was end of 2025.
Yeah. And I have a question for Nicos Rescos. Dry dock costs booked in the P&L, that is, we expense dry dock costs. Is that a usual industry practice? Is 55 million for 2025 a more or less normal number given the fleet size and age?
Thank you, Hamish. Well, I think we were able to say a lot about industry practice, but the short answer is we are able to have very cost competitive dry dock costs because of the number of ships we dry dock in China, and some captive relationships that allow our ships not to wait for too long before they dock. But more importantly, we need to look at this in combination with our operating expenses. That is to say, we don't wait to throw money on upgrading ships in dry dock. So it's a combination of having low OPEX and low dry dock costs. And the short answer is yes, it is well within industry practice, or I would say quite a bit less.
Yeah. And is 55 million a typical figure for us?
That would
That's
be
what
fair.
we've guided as well on the presentation. So
Yeah. And basically charging dry dock costs against, as an expense as opposed to accruing them is in fact what the SEC is asking for right now. So that is a typical industry practice. So I have a question. How does Starbulk assess the potential impact of President Trump's statements on his plans for the Panama Canal? I have to say that I'm not speaking for the company, but I think that I'm in agreement with the Wall Street Journal's editorial board, which stated that Panama Canal is not charging U.S. ships any greater fees than they're charging anybody else, and the U.S. Navy, under the treaty with Panama on the takeover by Panama of the canal, giving the U.S. Navy preferential access, that treaty is being honored. So I'm not sure what the problem is, but I assume that that will resolve itself in a peaceful and productive way. Let's see, do we have any? Oh, here. 5 new builds, say 250 million capex. Any offsetting disposals planned, i.e., net capex number for 25 and 26? Christos, Simos.
Yeah. First of all, the 250 million of capex is very much on the high side. Given our cost for these 5 new buildings, we're talking about capex of closer to 180 million USD, out of which we have already funded 10%. And essentially, we have secured financing for the delivery of those vessels of 130 million at extremely competitive terms. Therefore, given also the sale of vessels that we have already done, we have already raised the cash plus probably another 80 million required in order to fund the equity portion of this capex.
Okay, and I think we are hitting our deadline where we have to sign off. But I want to thank everybody who is on, and I hope you take a look at some of our filings and do your research.
Hamish and team, I'd like to thank you very much for joining us. As we can tell, this has been a very insightful discussion, an avalanche of questions, a lot of them still to be replied to, indicative of the interest in Starbuck. So thank you very, very much to everybody. As a reminder, this webinar will be available for replay on the Capital Link webinar website, capitallinkwebinars.com, and also on YouTube. Thank you again to everybody for joining us.
Thanks.
Thank you all.
Thank you.